October 16, 2009. 6 a.m. The Galleon Group headquarters, 590 Madison Avenue, Manhattan, New York, 18 floors above the still dark streets of Midtown. Federal agents from the Federal Bureau of Investigation and the Securities and Exchange Commission moved through the lobby in the first gray light of morning. They carried warrants, they carried evidence bags, and for the first time in the history of American securities law, they carried something no Wall Street suspect had ever had to contend with before. Recordings of his own voice, captured by court-authorized telephone wiretaps, describing crimes he believed would never be heard by anyone but trusted co-conspirators. Rajaratnam, the Sri Lanka-born billionaire founder of the Galleon Group hedge fund, had been the most powerful man in his corner of the financial world. At the fund's peak, it managed roughly $7 billion in assets. He had a Midas touch, or so his investors believed. His returns were extraordinary. His network was extraordinary. What none of them knew, what Wall Street's entire culture had collectively failed to imagine, was that the FBI had been listening to his phone calls for nearly 2 years. That morning in October 2009, the arrest of Rajaratnam marked the opening act of what would become the most expansive insider trading prosecution in American history. Agents and prosecutors called it Operation Perfect Hedge. Over the next 5 years through 2014, a single cascading investigation would ensnare 85 people, portfolio managers, hedge fund executives, corporate directors, expert network consultants, pharmaceutical company employees, and technology firm insiders, in a sprawling criminal enterprise built on the quiet passing of material, non-public information across Wall Street's most exclusive networks. The FBI had cracked open a secret world, and they had done it with a legal tool borrowed directly from organized crime prosecutions, the telephone wiretap. The story of how that happened, how federal investigators convinced a federal judge that a hedge fund billionaire's cell phone deserved the same surveillance treatment as a mob boss's landline, begins not with Rajaratnam himself, but with a thread pulled from a completely different case 3 years earlier. In 2006, FBI agents working out of the New York field office were running a money laundering investigation targeting a woman named Roomy, a former Intel Corporation marketing executive who had previously been caught passing tips to Rajaratnam. Khan had pleaded guilty to wire fraud back in 2001 in connection with an earlier scheme. Now agents discovered she was at it again, funneling non-public corporate information in exchange for a share of the profits her tips generated. But Khan was only a thread. Investigators began pulling. Every piece of information she passed, every call she made, every meeting she attended began to suggest something much larger on the other end of the line. The name that kept surfacing was Rajaratnam's. What made the subsequent investigation extraordinary was a legal argument prosecutors and FBI agents brought to the federal courts. An argument that had never been tested in a securities fraud case. Title III of the Omnibus Crime Control and Safe Streets Act of 1968 authorizes federal judges to approve electronic surveillance when investigators can demonstrate that conventional investigative techniques have been tried and failed or are unlikely to succeed, and when there is probable cause to believe the target is engaged in specific categories of serious federal crime. For decades, Title III wiretaps had been the province of drug trafficking cases and organized crime investigations. Securities fraud had always been treated differently, a paper crime, investigated with subpoenas and financial records and cooperating witnesses. No prosecutor had ever made the case to a federal judge that a hedge fund manager's phone conversations warranted the same treatment as a mafia underbosses. FBI Special Agent B.J. Kang and the squad assigned to the investigation made exactly that argument. Insider trading tips, they argued, were transacted in real time by telephone. Written records didn't capture them. By the time a subpoena was served and documents were produced, the evidence was gone. It existed only in the memories of the people on the calls. A wiretap, they argued, was not just appropriate, it was the only investigative method that could actually document what was happening at the moment it happened. The court agreed. In 2008, a federal judge authorized the first ever wiretap in a securities fraud investigation. Agents began recording Rajaratnam's calls. What they heard over the following months would eventually fill thousands of hours of tape and more than 2,000 recorded conversations, a real-time audio document of insider trading operating at the highest levels of American finance. The mechanics of the scheme, as the wiretaps and subsequent prosecutions revealed, were both elaborate and brazen. Rajaratnam had spent 2 decades cultivating a network of corporate insiders across Silicon Valley and Wall Street. These were not people operating on the fringes. They included senior executives at companies whose stock Galleon traded, board members of some of the most significant corporations in America, and employees at investment banks whose job descriptions gave them access to market-moving information that was supposed to remain confidential until public disclosure. Rajaratnam treated these relationships as a proprietary intelligence network, and he compensated the people in it accordingly, sometimes with cash, sometimes with favorable trading arrangements, sometimes simply with the mutual understanding that the relationship worked both ways. The tips flowed across a web of phone calls, text messages, and in-person meetings. A contact at a technology company would call with advance notice of an earnings miss before it was announced to the market. A pharmaceutical industry insider would pass word that a drug trial had produced positive results, information that would move a stock by 20 or 30% the moment it became public. A source embedded in the investment banking world would relay details of pending mergers and acquisitions that had not yet been disclosed. Rajaratnam would receive these calls, absorb the information, and within hours Galleon's trading desks would be building positions designed to profit from moves the rest of the market couldn't yet see coming. The FBI recorded call after call, in which sources explicitly named the companies they were discussing, explicitly described the non-public information they were conveying, and in some cases explicitly discussed the compensation they expected in return. The recordings were, in the language prosecutors would later use at trial, devastating. They transformed what had always been an enormously difficult white-collar crime to prove into something approaching a documentary. Among the first wave of evidence to emerge from the wiretaps was the name of a man who would eventually become the most prominent figure in the entire prosecution beyond Rajaratnam himself. Rajat Gupta had spent 3 decades building one of the most distinguished careers in American corporate life. He had served as the managing director of McKinsey & Company, the global consulting firm, from 1994 to 2003. He sat on the board of directors of Goldman Sachs. He sat on the board of Procter & Gamble. He had founded the American India Foundation. His name was synonymous with establishment, respectability, and philanthropic achievement at the highest levels of corporate America. The wiretaps, and the calls that investigators were able to reconstruct from phone records and other evidence, told a different story. According to the government's evidence, Gupta had been passing material non-public information about Goldman Sachs board deliberations directly to Rajaratnam. The most damning episode involved a Goldman Sachs board call in September 2008, at the height of the financial crisis, when the investment bank was in urgent discussions about a major capital infusion from Warren Buffett's Berkshire Hathaway. According to prosecutors, within approximately 1 minute of that board call ending, Gupta called Rajaratnam. Minutes later, Galleon began buying Goldman Sachs stock. When the Berkshire investment was announced publicly the following morning, the stock jumped and Galleon's position generated profits reported to be roughly $900,000. A second episode involved Goldman Sachs earnings information conveyed in advance of public announcement. Gupta was not charged in the initial October 2009 arrests. His prosecution came later as the investigation deepened and the evidence against him accumulated to the point that prosecutors believed they could prove his guilt beyond a reasonable doubt in front of a jury. He was ultimately charged with securities fraud and conspiracy. The October 2009 arrests themselves swept up 6 individuals alongside Rajaratnam. Among them was Robert Freeman, who had previously served as head of arbitrage at Goldman Sachs. There was Danielle Chiesi, a hedge fund analyst at Newcastle Funds, who the wiretaps captured discussing tips in frank and sometimes colorful terms. The recordings of Chiesi's conversations became some of the most widely reported exhibits in the entire case, evidence that illustrated how insider trading had become, in certain quarters of the hedge fund world, simply a part of the professional conversation. There was Anil Kumar, a senior partner at McKinsey & Company and a longtime friend of Gupta's, who had been passing tips about McKinsey's corporate clients to Rajaratnam in exchange for payments secretly routed through an offshore account in the Cayman Islands. Kumar eventually cooperated with prosecutors and became a key witness in the government's case. As the investigation expanded, prosecutors and FBI agents following the threads discovered that the insider trading web extended far beyond the original targets. The network included expert network firms, companies that operated as brokers connecting hedge fund managers with industry consultants who possessed specialized knowledge about publicly traded companies. These expert network arrangements were legal in many of their applications, but investigators found that a significant subset of them had crossed into criminal territory, with consultants passing non-public information about their own employers or former employers in exchange for consulting fees that were in reality payments for illegal tips. The investigation of expert networks produced its own wave of prosecutions. Primary Global Research, an expert network firm operating out of Mountain View, California, became a focal point. Several of its consultants were charged and convicted of providing material non-public information to hedge fund clients. Winifred Jiao, a former statistician at financial data firm NVIDIA who also consulted for Primary Global Research, was convicted in 2011 of securities fraud and conspiracy after prosecutors proved she had passed non-public information about quarterly earnings to hedge fund managers who profited from the tips. She was sentenced to 4 years in federal prison. Donxing Trang-Chu, a managing director at Primary Global Research, pleaded guilty in 2012 to conspiracy to commit securities fraud after admitting he had arranged for clients to obtain non-public information through the firm's network of consultants. His cooperation with investigators proved valuable in building additional cases. The pharmaceutical sector yielded some of the investigation's most striking prosecutions. Mathew Martoma, a former portfolio manager at hedge fund SAC Capital Advisors, one of the most powerful and profitable hedge funds in the country, became the subject of what prosecutors called the most lucrative single insider trading transaction in American history. Martoma had cultivated a relationship with Dr. Sidney Gilman, a neuroscientist and clinical trial expert at the University of Michigan, who served on the Safety Monitoring Committee for clinical trials of an Alzheimer's drug being developed jointly by Ellen Corporation and Wyeth. Through a series of meetings and conversations, Gilman passed confidential information about the trial's results to Martoma in advance of the data's public announcement. When the trial results proved disappointing, SAC Capital liquidated its position and went short, meaning it bet on the stocks falling. The fund avoided losses and generated profits on the short position that together, according to prosecutors, totaled roughly $275 million. Martoma was convicted in 2014 of securities fraud and conspiracy after a jury trial in Manhattan. He was sentenced to 9 years in federal prison. Gilman, who cooperated with the government, received no prison time. SAC Capital itself, the hedge fund run by billionaire Stephen A. Cohen, became the target of a parallel investigation. While Cohen himself was never charged with insider trading, his firm faced extraordinary legal pressure. In November 2013, SAC Capital Advisors pleaded guilty to securities fraud and wire fraud charges relating to insider trading by employees, agreeing to pay approximately $1.8 billion in penalties in what was then the largest insider trading settlement in American history. The firm was effectively required to shut down its investment advisory business as a condition of the settlement. The prosecution of Rajat Gupta proceeded separately from the Rajaratnam trial. At Gupta's trial, prosecutors faced the challenge that he had not personally traded on the information. The direct financial benefit to Gupta himself was harder to demonstrate than in cases where the tipper received explicit payments. Prosecutors argued instead that the benefit was the relationship itself, the access, the reciprocity, the cultivation of one of the most powerful men in American finance as a grateful beneficiary of confidential board information. The jury agreed. On June 15, 2012, after a trial in Manhattan federal court before Judge Jed Rakoff, Rajat Gupta was convicted on 3 counts of securities fraud and 1 count of conspiracy. He was sentenced to 2 years in federal prison and fined $5 million. For a man whose career had represented the pinnacle of corporate respectability, the verdict and sentence were received as one of the most significant white-collar criminal convictions in decades. The trial of Rajaratnam himself, which preceded Gupta's by approximately a year, was the centerpiece of the entire prosecutorial effort. Prosecutors played the wiretap recordings for the jury in open court, the actual voice of Rajaratnam in his own words, discussing the tips he was receiving and the positions he was taking. His defense argued that many of the positions reflected legitimate research and analysis, and that some of the information he discussed on calls was already publicly available, or based on reasonable inference rather than genuine inside knowledge. The defense also challenged the use of the wiretaps themselves, arguing they had been improperly obtained. The jury rejected those arguments. On May 11, 2011, after 9 days of deliberations, the jury returned a verdict convicting Rajaratnam on all 14 counts, 9 counts of securities fraud and 5 counts of conspiracy. Judge Richard Holwell sentenced him to 11 years in federal prison and ordered him to pay a fine of $10 million and to forfeit $53.8 million in illegal profits. At the time of sentencing, 11 years was the longest sentence ever imposed for insider trading in American history. By the time the dust had begun to settle in 2014, the investigation that had started with a thread pulled from a money laundering case had produced convictions of 85 individuals across the hedge fund industry, the expert network industry, and the corporate world. The cases spanned companies in the technology sector, the pharmaceutical sector, and the financial services sector. They reached from senior partners at elite consulting firms to board members of America's most iconic financial institutions. They produced guilty pleas and trial convictions from portfolio managers who had never imagined they could be caught because they had never imagined the government would be listening. The FBI's decision to use wiretaps, that first ever application of Title III surveillance to securities fraud, had not merely caught Rajaratnam, it had revealed an entire culture. The recordings made clear that the trading of material non-public information had become, in certain circles, almost routine. It was the coin of the realm and a network where access to information was power, and where relationships were maintained by the mutual exchange of useful things. The wiretaps captured voices that were entirely comfortable discussing illegal tips because, in the context of those conversations, the tips felt like part of an ordinary professional dialogue. That comfort, that sense of impunity, was perhaps the most telling thing the recordings revealed. Prosecutors and FBI officials who worked the case were explicit about what Operation Perfect Hedge was intended to accomplish beyond the convictions themselves. Deputy Attorney General Lanny Breuer, speaking in the aftermath of the Rajaratnam sentencing, described the investigation as a signal to the entire financial industry. that the government now possessed tools and the willingness to surveil the communications of senior financial professionals in the same way it had long surveilled drug traffickers and organized crime figures. The message was calculated and deliberate. The comfortable assumption that insider trading was a victimless, undetectable, white-collar gray area was no longer valid. The FBI was listening, and from 2009 forward, the industry would have to reckon with that reality. The aftermath of Operation Perfect Hedge reshaped how investment firms approached compliance. Law firms specializing in securities regulation reported a surge in demand for training programs specifically addressing the legal lines around expert networks and information sharing. Major hedge funds overhauled their information barriers and monitoring. Several expert network firms shut down entirely. The industry did not stop seeking informational edges, that is the fundamental enterprise, but it became significantly more cautious about how those edges were obtained. Rajaratnam began serving his 11-year sentence and was released from federal prison in 2019, having served approximately 7.5 years. His health significantly diminished. The fund he had built was dissolved. The fortune he had accumulated was substantially reduced by fines, forfeitures, and civil penalties. Rajat Gupta, the man who had stood on the boards of Goldman Sachs and Procter & Gamble, who had shaped global economic policy discussions through the World Economic Forum, served his 2-year sentence and emerged into a dramatically reduced public life. The relationship with Rajaratnam, the network that had felt from the inside like simply the way the world of powerful men operated, had cost him everything he had built over 30 years. The wiretaps that made it all possible had captured something that pen registers, subpoenas, and trading records never could: the human reality of how financial crime actually operates. Not as a lone individual making isolated decisions in secret, but as a social phenomenon. Conversations between people who trusted each other. Information passed in the language of mutual obligation and shared professional culture. Crimes committed not in the dark but in the ordinary light of professional life. In voices that sounded entirely relaxed because their speakers had never once imagined they were being heard. That was what the recordings proved, most fundamentally. Not just guilt, not just dollar amounts, but the texture and the architecture of a world where the most serious securities fraud in American history had operated for years in plain telephone conversation sight, waiting only for someone to finally think to listen.